for maybe any clarification that you need from me. And if not, maybe we can take a bit of a breather at this point. Um, the rest of this discussion, um, I'm going to pause the recording for a second. All right, good folks. So we're going to look at a few examples of the application of the measurement approach. And essentially what we're going to be doing is look at how the measurement approach has been incorporated in our financial reporting standards. So we're going to go through the financial statements and then see how that's been done. We will then digress a little bit into material that is more appropriate for an advanced financial accounting class. Talk about primary and derivative financial instruments. You folks learned about derivatives a little bit in your second intermediate class, and then a little bit more when you do advanced financial. So I don't know how many of you have taken intermediate two or are currently enrolled in advanced financial. So that is my part of the reason why I don't really think this is material that is appropriate for testing purposes. Good to know, but not really appropriate for testing purposes. We will look at approaches to risk reporting, reporting on risk, and that is something that companies have to do in their MD&A as well as in other places. And then we will consider the challenges that companies face with regards to accounting for intangible assets. The problems are more strenuous for companies that report under US GAAP and those under IFRS, but there are challenges regardless. So starting with an outlining of examples of measurement-oriented accounting standards. So firstly, in terms of um, how measurement has been sought to be incorporated, um, you may remember from intermediate one that companies conduct impairment tests, right? And as part of the impairment tests for IFRS for sure, we compare the carrying amount of an asset, which is net book value, at the cost of the asset minus the accumulated depreciation to that point. We compare that carrying amount to a recoverable amount. And the recoverable amount is, under IFRS, the greater of two numbers, value in use and fair value less cost to sell. Fair value is a market-based measure, right? Typically, you would expect to see a market for that asset um, where that used assets could be bought and sold. Now, if that market doesn't exist, then we have to resort to looking at values of similar assets, which are considered level two in terms of inputs. And when that's not available as well, then you have the level three, which is essentially the same concept as value in use, because you're doing a present value of future expected cash flows from the use of the asset. Right? So there is a bit of an interlinkage in how we come up with those numbers. So as a company, are we better off continuing to use this asset, or are we better off selling the asset? Right? And the greater of the two is considered the recoverable amount, and we compare the recoverable amount to the carrying value of the asset. If the carrying value is more than the recoverable amount, then we say the asset is impaired, and the difference between the carrying value and the recoverable amount is recorded as impairment loss. This is something that you would have learned in your first intermediate course. If you consider the rest of the balance sheet, then if you walk through the balance sheet, it'll make sense. Cash is reported for what it is, right? Cash is reported for what the amount of cash is at this point in time. move down from cash, and you'll find that accounts receivable. Well, accounts receivable are reported at net, the net realizable amount, right? We report accounts receivable net of an allowance for doubtful accounts. So companies are expected to provide for the possibility that some of the people that owe us money may not pay as promised, right? So we subtract that, right? We subtract that amount from the gross value of accounts receivable to report the net number. Um, if you consider inventory, right? If you consider inventory, inventory is reported at the lower of cost or net realizable value, right? Where net realizable value is the estimated selling price minus cost to sell. Even there, although we would prefer to report the inventory at cost, if the value of the inventory has fallen below the original cost, then we would report it at the lower of the two, right? So we are in a way incorporating current value information in there, provided the current value is not less. If the current value is lower than the cost of the inventory, then we report the inventory at the lower of the two. If you consider investments that are carried at fair value, right? So fair value, profit or loss, any kind of trading investments will be reported at fair value, and any changes in fair value are reported through net income. That too you would remember from your earlier accounting classes. Prepaids are reported at whatever the historical amount was. So there is no difference between how much we paid for a prepaid expense and what value we're able to derive. Because typically, when it comes to anything that's prepaid, usually it's hard for us to recover. If I've paid for a certain service, it's hard for us to go back and ask for the money back. Generally, that's the reason why prepaids are, on a balance sheet in order of liquidity. Prepaids come after the rest of the current assets. If you move on to long-term investments, you'll find under long-term investments, the only item that is reported at fair value is once we have investments that are reported at fair value with changes going through OCI, right? So there's the fair value through OCI model. So those investments get reported at fair value, but the rest of the investments, they could be investments in associates that you would have picked up that are reported under the equity method. They get reported basically at the adjusted value following the equity method. If you have investments in bonds, they're usually reported at amortized cost. Unless the investment is impaired, we report the investments at the amortized cost or adjusted under the equity method. So a bit of a departure from current values. If you consider property, plant, and equipment, IFRS allows companies to use fair value information. Companies can report assets at fair value. They are allowed to revalue the assets. But if you use the revaluation model, if the asset value goes up, then remember the company cannot record the increase in fair value through net income as a gain, right? The increase in fair value gets recorded as other comprehensive income, OCI. However, if the asset value was to go down, the loss could very well be reported in P&L, right? So that kind of creates a bit of an asymmetry in accounting treatment. If asset values go up, they go through OCI, but if they fall, there is a possibility of recording a loss due to the revaluation. There are exceptions. So the exceptions apply to investment properties. So if a company has investment property, IAS 40 applies, and the company can choose to report investment property at fair value. That is, again, something that would have been talked about in the first intermediate accounting course. Uh, companies that engage in agriculture, they report they have um, if they have what you're called biological assets. So companies engaged in agriculture, if they have biological assets such as animals or plants that are used to either for their own purpose or to produce, so if you're talking about crops, right? So companies that raise crops, those biological assets can be reported, or they are rather reported at fair value less cost to sell. So that's an exception. Usually, companies will report their property, plant, and equipment assets at historical cost, original cost minus accumulated depreciation. But even when historical cost is used, companies have to pay attention to the possibility of impairment. And the impairment test requires a comparison of the carrying amount to the recoverable amount, right? On the liability side, if you consider liabilities, current liabilities are reported at the amount owed. Usually, companies will not reduce an account payable for an allowance for doubtful payables. Like you have allowance for doubtful accounts receivable that acts as a contra asset, but for liabilities, usually companies will report the liabilities at whatever the historical number is. Longer term liabilities, though, if a company has bonds payable, that kind of a long term debt is usually accounted for at amortized cost. If the debt was issued for a value other than par value, so if you issued bonds for more than the par value, then that's bonds issued at a premium, or they could be issued for less, that would be bonds issued at a discount. In either case, those bonds are accounted for at amortized cost, with the premium or discount being amortized over the time to maturity using an effective interest rate. This is something that you learned in your second intermediate accounting course. Companies would have leases. So if they have lease liability, then there would be a corresponding right of use asset that gets shown on the asset side. And then you have the lease liability that is accounted for at amortized cost, just like other long-term debt. If a company has a defined benefit plan, pension plan, let's say, the pension number is reported as the net of the plan assets and the plan obligations, the defined benefit obligations. The defined benefit obligation is it's not reported on the balance sheet of the sponsor company. It's taken care of by the plan trustee, and the sponsor, the company that sponsors the plan, only reports its net obligation, its net defined benefit liability, or in rare cases, a net defined benefit asset. And that too you would have learned in your second intermediate accounting course. So looking at each one of them in slightly more depth, accounts receivable and payable, they are measured at face value. We don't do a time value calculation. And the rationale for that is that accounts receivable, accounts payable, accounts receivable are collected usually in fairly short period of time. And what makes it short is the arbitrary distinction is 12 months. So if you have a receivable or a payable that is due within 12 months from the date of the balance sheet, we don't do any time value calculation. We don't do any PV calculation on it. We just report them at face value. And accounts receivable are reported net of an allowance for doubtful accounts. So net realizable value is what we report the accounts receivable at. And there is an assumption that under normal circumstances where the rate of inflation is not very high, the amounts that we report for the accounts receivable and accounts payable, they approximate what their present value would be. For cash flows that are fixed by contract, for example, long-term debt and leases, we report those amounts on the balance sheet, and especially the liabilities are reported at historical costs, as amortized costs rather. If there's any discount or premium embedded, that discount or premium gets written over time off, uh, adjusted into the interest expense, and that is done for IFRS using the effective interest rate method. The lower of cost or market rule in IFRS parlance, that's the lower of cost or net realizable value. That is applied for inventory, and it is an approach that is supportive of prudence, conservatism, and it helps ensure that we don't accidentally overstate our assets because that could lead to lawsuits. That's bad for everybody. IFRS permits the use of revaluation of property, plant, and equipment. We talked about that. Um, of course, the assumption is that fair values should be readily available. For an asset for which we don't get fair values, we should not use the revaluation model. If the asset value goes up, it gets recorded in OCI. If the asset value goes down, then we first wipe out any existing other comprehensive income accumulated OCI for that asset, and then any further decline in value will get recorded as a loss in the income statement. Um, if you folks did the revaluation model in intermediate one, you will remember that um, reversals of impairment losses are permitted, but there are certain caps to how much of loss recovery is possible. There are ceiling tests in place for assets, and that's your impairment. So in IFRS, that's what we do. We compare the carrying amount of an asset to the recoverable amount, which is the greater of value in use and fair value less cost to sell. The impairment test under ASPE is a little different. You'll remember there, what we do is we compare the carrying amount to the undiscounted future cash flows. If the carrying amount is more than the undiscounted future cash flows from using the asset, then we write the asset down to its fair value. Impairment is only said to have occurred when the undiscounted future cash flows from using the asset are below the carrying. So that's quite a bit different from the IFRS approach, and you would have learned the details in your first intermediate accounting class. If you don't remember them, it would be a good idea to review them before you start your CPA journey, because CPA will expect that you remember all of that. So that's what I was mentioning. US GAAP and ASPE, they have a different take. You compare the carrying amount to undiscounted future cash flows. And if the carrying amount is greater than the undiscounted future cash flows, then the impairment loss is recorded as being the excess of the book value over fair value, not undiscounted, but fair value. And ASPE does not allow reversals of impairment losses. And that's the same for US GAAP. Pensions and other post-employment benefits, these are covered under IAS 19, and which basically requires past service costs, current service costs, net interest costs, all to be booked through pension expense, which hits the income statement. Any kind of actuarial revaluations or experience gains and losses are booked through OCI. That's something you would have picked up in your second accounting course, your second intermediate course. And again, I don't know where every one of you is placed at. I'm assuming that since this class is accounting 415, you have taken both your intermediate accounting courses. Some of you might be currently enrolled in an advanced financial accounting class. So something that we will talk about in the upcoming slides will be applicable there. But much of what I talked about so far has already been covered in your intermediate courses. So next piece is looking at financial instruments and accounting standards for reporting derivative financial instruments as well as primary. So the definition of a financial instrument is something that you would have picked up initially in intermediate accounting. And so these are essentially contracts that result in the creation of a financial asset for one party and a financial liability for another. And there can be two types of financial instruments. One, derivatives are where you have options, forward contracts, futures, warrants, those kinds of things, where the value of the financial instrument is derived from the value of something called an underlying. Now, that underlying could be a commodity, it could be a security, it could be a rate, multiple possibilities. So, for example, as I mentioned, options could have swaps, currency swaps, interest rate swaps, forward contracts, future contracts. Essentially, those are good examples of derivative securities. And in your second intermediate course, there was a chapter called complex financial instruments. I think chapter 16, if I'm not mistaken. There you saw some examples of that. And in advanced financial, you will do some more in chapter 10 of your advanced financial accounting. IFRS 9 is the reporting standard now for financial instruments. Previously, it was IAS 39. IFRS 9 has been around for many years now. IFRS 9 was an improvement upon IAS 39 on many counts. It was a response to the financial crisis of 2007, 2008. The first draft of IFRS 9 was actually published in 2009. And the intention was that the standard would become effective starting 2011. It never happened. It went on and on. I think it finally became applicable, if I'm not mistaken, in 2015. There was an initial talk of 2013 application, but I think it got pushed back to 2015, or was it 2018? I don't remember, but it did get pushed back quite a bit. One of the things that IFRS 9 did was it came up with this concept of business model, right? So um, in the past, companies could choose how they wanted to account for certain finance. That's no longer possible because that choice is now governed by what the company intends to do with that particular financial instrument. All right. So that has, for example, if a company buys bonds issued by another company, well, you kind of do a classification test there. What's the intention behind buying the bonds? Do we intend to just receive the contractual cash flows and hold on to these bonds until they mature? Well, in that case, if the answer is yes, in that case, we should account for those bonds under amortized cost. If we are not sure about holding on to the bonds until they mature, but we would like to hang on to them as long as possible, then maybe use fair value through OCI. If, on the other hand, the bonds were bought as a short-term trading investment, must use fair value profit or loss. For investments in shares issued by another company, the default is to report the shares at fair value with any changes going through profit or loss. However, if these shares were bought as a long-term investment, the investing company can make an irrevocable election in the year they buy the investment, the first time ever, to apply fair value through OCI, right? In that case, any changes in the value of the shares subsequently will go through other comprehensive income. So, it does come up with those guidances about what accounting model should be used. Um, Most part, other than the one specifically where you can use amortized cost, and amortized cost is only applicable from the point of view of financial assets. You can only use amortized cost for investments in bonds issued by other companies. Everything else really needs to be reported at fair value. And changes in fair value usually go through net income. And in certain circumstances, they can go through other comprehensive income. It is possible to reclassify financial instruments from one class to the other, but it tends to be a little more difficult, right? And there are restrictions. For example, if you um, elected to use fair value through other comprehensive income for an investment in shares, you can't reclassify them as fair value profit or loss. Nor can you reclassify shares that were earlier accounted for as fair value profit or loss into fair value OCI. So for shares, intercategory reclassifications are not possible. For bond investments, it is possible, but there are sort of, there are guidelines that have to be followed. It's kind of difficult. We mentioned OCI, and you folks have learned about OCI. The history of OCI is that following Jim Olson's mean surplus model, the accounting standard setters in the US, especially, began working on this all inclusive concept of income called comprehensive income, which they said is made up of two pieces: net income and OCI, other comprehensive income. And so OCI incorporates a whole bunch of unrealized gains and losses, and they are very specific sources of unrealized gains and losses. If I could count, there's basically 5 sources of OCI. In intermediate 1, you would have learned about investments that are accounted for at fair value through OCI. So that's one possibility. The revaluation model for property, plant, and equipment allows companies to report their PP&E items at fair value with any increase in fair value going through OCI. 2 examples you picked up in your first intermediate accounting course. In intermediate 2, you will have learned about pensions, so defined benefit pension plans. Any remeasurement gains and losses go through other comprehensive income. All right. And then in advanced financial accounting, you will learn about cash flow hedges. If a company uses cash flow hedge, then changes in the cash flow hedges go through OCI. And then lastly, if a company has a self-sustaining foreign operation, the gains and losses on translating the foreign operation go through OCI. So those are 5 possible sources of OCI. Nothing else really goes in. A very, very, very specific concept that has been borrowed by IFRS from US GAAP. We didn't have OCI in IFRS until very recently, until the last decade or so is when we've had OCI. Prior to that, it was a US concept. ASPE doesn't have OCI, right? So in Canada, we didn't have other comprehensive income until we embraced IFRS. IFRS 13 has been around for a while, and it was a standard that was developed in response to the 2007-2008 financial crisis, in which all of a sudden, markets for certain kinds of assets just disappeared. Like you had houses in the US where, typically housing market is fairly robust. There's people looking to buy, people looking to sell, and transactions happen all the time. But in that time, in the 07-08 financial crisis, there were a lot of people declaring bankruptcy, walking away from their mortgages. In the US, you can do that. In Canada, that's not possible, but in the US, people could walk away from their mortgages. And so what was happening was a lot of houses were getting foreclosed upon. And because there was nobody else looking to buy those houses, the prices, the values of those houses just plummeted literally. You could theoretically, there were certain parts of the US where a house that was possibly bought or sold just a couple of years ago for $700,000, $800,000 could be bought for 150,000. That kind of a drop, right? That's not normal. So when you have that kind of a situation, or you have assets for which nobody's looking to buy, there's suddenly market has disappeared. Well, then we needed some additional guidance as to how fair value should be determined. IFRS 13 was developed with that view in mind, and it designated a hierarchy of input levels. There's level one, where you have market prices. So think about shares of a publicly traded company. All you have to do is look at the last traded price. Done. You know how much the shares are worth. Multiply the number of shares by the market price, and you got it. Level two is where you don't have market prices for the said asset, but you can infer the value from looking at prices of similar assets. And that's where usually real estate comes in. So let's say if I wanted to sell my house, I would I would have to engage services of a real estate agent who will come in, take a look of around my house, the condition the house is in, the exterior, etc. They look at the area, and then they will do some kind of a market survey, and they'll see, okay, in the last 6 months, within this area, the community that my house is in, other houses have sold for these prices. So you would compare the square footage, the built, whether they had a walkout basement or not, etc., etc. The exterior, was it stucco? You get the picture, right? They'll put in a whole lot of parameters into the thing, and they would come up with a range of, okay, this could be a potential value for the house, and that would then give me an idea as to how much I would like the house to be listed for. If I am not interested in listing, but I want to go in for a bank home equity loan, the bank will make me do a similar exercise. The bank will send their own appraiser that would come in, take measurements, and so on. But they will provide the bank with a value estimate. And then the bank will do their calculation to tell me, okay, Harjinder, we can extend a certain home equity line of credit on this house. Even though I'm not selling, that value of the house was used as an input to determine how much of a line of credit I can get on my house. That's still an example of a level two approach. I'm not sold my house, but I'm trying to infer how much it's worth based on values of similar properties that have been sold in the recent past. Level three is kind of where you don't even have such comparable value. That's where the most amount of measurement error comes in, because literally there you have to do a net present value approach. So for those of you that have done capital budgeting, you estimate what the cash flows will be relating to the asset into the future, and then do an NPV calculation using an appropriate discount rate. So that is the third level of input hierarchy, the least reliable. The most reliable would be observed market prices. Least reliable would be the management determined values doing a PV calc. Now, when you're using anything other than market prices, you do need more disclosure, right? And anytime a company is reporting fair values, they need to provide disclosure about how the fair value was determined. Now, a valid question to ask would be, why do we not report all financial statements at face value, right? Why do we report some of them at fair value? So In part, the answer lies with reliability. If fair values cannot be measured reliably, we should not use them. So face value is appropriate. And then the second is, if the fair values change, I think this should have said fair value. I think face value is a typo. Why do we not value all financial instruments at fair value? I think that makes more sense. One reason we don't is fair values can sometimes be less reliable. And the second is sometimes these fair values are very volatile, right? They go up or down very, very, very rapidly. And including reporting these financial instruments at fair value in that case could result in the net income number being too high or too low, right? And that can be seen as an indicator of risk by market participants. And so companies would want to avoid that. And that's one of the compelling reasons for why we have the concept of OCI, right? We are able to isolate some of the changes in fair values of these financial instruments. And rather than flowing them through net income, we report them in the comprehensive income. So are we going okay so far? Any questions? I know I've been the one that's been doing a lot of talking. I don't know how much of it is really jiving. It totally depends on where you folks are at with your financial accounting classes. Some of it, if you've taken these intermediate courses more recently, will seem, yeah, okay, yeah, we did talk about that in class. It's been a while, and Lord forbid, if you took your intermediate accounting many years ago, then this stuff would sound very alien because you most likely did not learn your intermediate accounting under IFRS. If let's say you transferred in from someplace else, that too could be an issue. So I'm just having to make these assumptions about the currency of your knowledge with regards to financial reporting. So when I said a lot of this will seem like review, that is the reason why. At any rate, this piece will not be examined. You won't find exam questions on these specifics because realistically, this is material that is better suited for your financial accounting classes and not accounting theory. IFRS 7 deals with disclosures. So IFRS 7 talks about a bunch of disclosures that are mandated in IFRS, including disclosures of gains and losses, gains and disclosures of fair values, assets that have been derecognized, but the company continues to have an involvement. All of those need to be provided as far as IFRS 7 is concerned. Then requirements with regards to derecognition and consolidation. So much of this piece is kind of old hat for those of you that are currently taking advanced financial accounting. You will know that whenever a business combination occurs, so a business combination is where one company takes control over another. Business combinations can happen in one of three ways. One is through the purchase of all the assets and assuming all the liabilities of the other company. If that happens, consolidation isn't needed because the company that bought out the acquirer gets to record all the assets and liabilities on its own books of record at fair value. And if the consideration transferred is greater than the fair value of assets and liabilities assumed, the difference gets recorded as goodwill. If, on the other hand, control has been obtained through the purchase of common shares or through the setup of a special purpose entity, then consolidation is needed, right? So in the past, there was some confusion about when consolidation is required. IFRS has clarified that if you have a business combination, consolidation is needed unless it was a purchase of net assets. ASPE, companies still have the option of not consolidating, okay? So private companies don't need to consolidate. IFRS, it's clear. You have to prepare consolidated statements. So that is um, fairly standard now. Derecognition relating to financial instruments should happen when the company ceases to have control over risks and rewards. So when the risks and rewards in the financial instrument are transferred over to another party, then the financial instrument should be removed from the books of the company that had them in the first place. That's basically, nothing sinister there. If you think about accounts receivable, you may remember from intermediate one, securitization of accounts receivable, transfer of accounts receivable, right? So companies will often sell their accounts receivable to just speed up or to get more liquidity. So if the risks and rewards in the accounts receivable are transferred to the other company, then they get derecognized and a loss on transfer is recorded by the company. So you think really hard, I think it would have been chapter 7 from intermediate 1. You don't remember, go back, take a look. Transfer of accounts receivable, you will see the rules related there. So companies will remove the accounts receivable from their books if it is a sale, right? Otherwise not. If you consider leases, sale and leaseback, if there's a sale and leaseback transaction, it is not considered a sale if the seller lessee continues to have involvement in the asset, right? So again, you go look up that chapter 17, I think it is from your second intermediate class. You will find another example of this derecognition that when risks and rewards are transferred, the asset or that particular item should be removed from the books. Accounting for derivatives. So how do companies account for derivatives? You will learn, or you would have learned about this in intermediate 2 and in part in your advanced financial course. In general, the derivatives are recorded at fair value, and any changes in fair value go through net income unless the derivative is part of a cash flow hedge, in which case there are certain circumstances that the change in value is recorded in OCI, other comprehensive income. You don't want to overcomplicate it because that's not the intention of this particular class. So in advanced financial accounting, you're going to learn about fair value hedges. It is one way of accounting for a scenario where a company takes out a derivative position in order to protect against the risk of a gain or loss on something else that is exposed to the same risk. So this is again, a very complicated scenario. In advanced financial, you folks will learn about the use of forward contracts, okay? Where, say, a company that engages in buying or selling in foreign currency. So a company, let's say, that either buys goods or assets in a foreign currency or makes sales in a foreign currency other than a Canadian dollar, and is therefore exposed to the possibility of exchange rates relative to the Canadian dollar going up or down, right? So if I have, let's say, as a company, I buy equipment from Japan, and for some weird reason, the supplier from Japan insists that I pay them in yen. As a Canadian company, if I have to make a payment in Japanese yen, I will be concerned about the possibility that the Japanese yen will become stronger relative to the Canadian dollar, right? If the Canadian dollar depreciates, then since when I have to go and make payment in yen, I'm going to have to buy yen, right? If the Canadian dollar weakens relative to the Japanese yen, I'll have to pay more Canadian dollars for the same amount of payable. So there, companies can use derivatives. In advanced financial accounting, you folks will learn about the use of forward contract. So a forward contract is where a company enters into a contract with a bank or another, like a foreign exchange trading company, to buy or sell foreign currency. So in our example, the Canadian company that needs yen to pay for the purchase of equipment will set up a forward contract to buy yen from the bank, okay, at a predetermined rate. And so from the Canadian company's point of view, they have an account payable in yen, which is called the hedged item. And then they have this receivable from the bank in yen, which is our hedging instrument. And so we can designate that relationship as a hedge, right? We can say the forward contract acts as a hedge for my accounts payable in yen. So once you designate that, then we can apply fair value hedge. And what will happen is that if there is a change in exchange rates that results in, say, a loss on my account payable, so if the Canadian dollar does go down in value, it weakens against the yen, then I will have a loss on the account payable, but I will experience a gain on my forward contract because I am going to be receiving yen from the bank, and the value of those yen in Canadian dollars would have gone up. So loss on my hedged item is offset by a gain on the hedging item. It could be vice versa as well. So the net outcome is that the overall profit or loss that gets recorded in the income statement is minimal. So again, that is a very, very, very high level summary of a concept that you will learn in an entire class in advanced accounting. I can't do justice to that here. So suffice it to say, it's a very complex, fairly high, uh, fairly advanced level concept that you're going to pick up in advanced accounting, advanced financial accounting class. Cash flow hedges is another possibility. Similar situation which you learn about in your advanced financial class. And the difference here is that the volatility, to avoid the volatility, instead of reporting gains and losses in profit and loss in net income, for a certain length of time, the gain or loss on the derivative is actually recorded in OCI, other comprehensive. Okay. Hedge accounting, you will learn in advanced financial accounting, is optional. It's not the same thing as accounting for hedges. It is basically a mechanism of timing the recognition of gains and losses on a hedging instrument to that of gains and losses on the hedged item. For that, you have to understand what's a hedge. Right now, I don't think we have the length of time to even try to explain. If you're interested, I have YouTube recordings of my advanced financial class. You can go and watch. But I'm sure if you take advanced financial accounting 434, you will learn about it. Anyway, your instructor will cover it. I'm not currently teaching advanced financial for SAGE. I don't know who is teaching in this semester, but whoever it is, whether it's Leonard or whoever is doing that, they will cover when you get to that. Hedge accounting so requires that there should be a qualifying hedged item and a qualifying hedging instrument. And there should be a formal designation of the relationship that the derivative, or it could be something else, is actually being used to hedge the risk of the hedged item. The receivable or payable that is exposed to the risk of change in value due to movements in exchange rates, for example. There's a lot of disclosure that is required, and that would make sense that IFRS is all about disclosure. companies, if they, you know, um, companies have choices under IFRS, but companies are also required to provide more disclosure so that users of financial statements are able to make better sense of what the numbers are. Risk reporting is again something that has been recognized by financial statements, financial standard setters as being an important piece. So although uh, Securities and Exchange Commission in US and the Ontario Securities Commission, for example, in Canada, they have their own requirements for companies to talk about risk in the management discussion and analysis, the MD&A section. Standards also require discussion of risk. Most of the risk reporting still gets done in the MD&A part. And risk can emanate from many, many, many sources, but two very common sources of risk relate to the risk of price and the risk of credit. So these are risks that typically get addressed in expanded commentary that is included in MD&A, management discussion and analysis. And that's the part that precedes the financial statement information in any annual reports. If you click on an annual report of a company, you'll find that the earlier bunch of pages are provide a general narrative about what happened during the year. You'll find that it's all glossy and lots of pictures and so on. That's kind of the MD&A part where top, management of the company is kind of sharing their perspective of what happened. And then when we get to the financial statement information proper, it generally tends to turn very monochromatic, right? And all of a sudden it becomes all black and white, and it's just numbers followed by note disclosure, which is very boilerplate and looks like legalistic language. MD&A, on the other part, tends to be more conversational, easier to follow. And that's just how things are. The MD&A part is not considered, um, the MD&A is not part of financial reporting per se. So it's not part of, there's no guidance provided by IFRS, for example, about what should go into MD&A. That guidance is instead provided by the securities commissions that govern where the company's stocks are listed. So if it was the US, it'd be the Securities and Exchange Commission. In Canada, the company is listed on the Toronto Stock Exchange, for example, it would be the Ontario Securities Commission. Why do companies need to provide disclosures on risk? It's basically to avoid litigation, right? You don't want after the fact lawyers to come after you. Oh, why did you not disclose this? Why did you not let shareholders know that there was a risk of losses arising due to such and such? So IFRS 7 is the standard that relates to all disclosures, including risk disclosure. So IFRS 7 requires information about different kinds of risk, including credit risk. And there is risk disclosure required under IAS 39, which has since been replaced by IFRS 9. So this slide needs to be updated. It's now IFRS 9 that has certain risk disclosure requirements. And US reporting standards also have risk reporting requirements, which now Canadian companies often raise capital. They're listed, Canadian companies are listed on US stock exchanges as well. So they have to be in compliance with the Securities and Exchange Commission requirements in the US. A lot of times, if you were to go through the financial information of top Canadian companies that are also cross-listed on the US exchanges, you'll find that they will provide fairly extensive discussion of the types of risks that they face, and they will provide information about the dollar amount, the value at risk, and they will also kind of give you an indicator of how sensitive those numbers are to possible changes in assumption. So one assumption when it comes to, let's say, doing valuation is the discount rate. If you're calculating PV, present value, you need an estimate for future value. Okay, so maybe there is a possibility of error there. You need an estimate for the routine cash flows, the PMTs over time. So, companies would provide some kind of, oh, on the higher end, this is the possible cash flow, lower end, this is the possible cash flow. And then another source of changes in value would be the discount rate, right? The I by Y that you use. So companies will often carry out sensitivity analysis around that, make different assumptions about discount rates to use, about the cash flows to use, about the terminal values to use, and to get a sense of how much could be because you don't know what will happen 5, 10 years down the line, right? To, to give people a sense of what management has considered before arriving at a decision, let's say, to make a capital investment decision. Say an oil and gas company is deciding on investing $10 billion over certain oil and gas assets. What led to that decision? They must have done a lot of calculation. So disclosure around how those numbers were arrived at, including sensitivity. Last little piece for the discussion of measurement applications, and that's the treatment of good old-fashioned intangible assets. This is a biggie for a lot of people who argue that what is often missing from companies' balance sheets is information about goodwill. As of now, goodwill can only be recorded when a company has bought another company's net asset. That's the only time that a company on its separate company books, on its separate entity books, will ever report a line for goodwill. The goodwill has to be purchased, and it should be the outcome of a business combination done through purchase of net assets. Otherwise, consolidated financial statements, there might be goodwill reported, but that's not a separate company books, and nowhere else. Now, a lot of people make the argument that there are certain companies that do a far better job than the average company in terms of building up its processes, or they have really loyal customer base, or XYZ, whatever is the reason for why the market values one company much, much, much higher than the rest of its peers. There's got to be a reason why. And a lot of the time, people have come up with this good old-fashioned word that starts with the letter G, goodwill, right? There's goodwill, there's goodwill. However, accounting standard setters are very clear that self-developed goodwill cannot be reported, period. Now, that then means if you cannot report self-developed goodwill, then for a company that has good prospects in the future, right? The company that has a bright future, the market is able to recognize it, right? So the market would be able to say, oh yeah, this company is going to do really, really well. But its net income numbers don't reflect it because all the amount that the company is putting in to enhance its relationship with customers, to implement strong business processes, et cetera, because of our accounting reporting standards, they get expensed. So if you look at their net income numbers, those companies might be loss making, or they might have very, very minuscule profits at the moment, right? So there are companies that trade at crazy multiples, PE multiples. And you go, why is the market crazy? Well, the market isn't crazy. The market is able to see that this company is really at the crux. They're almost at the threshold of just breaking out. Give it a couple more years and this company is going to be a rock star. Right now, not. It's not earning a lot of money. So there's this lag in recognizing the value, right? There's a recognition lag. Our accounting numbers tend to be delayed, right? Our accounting numbers do not reflect. If you were to look up Google's, for example, the company is now Alphabet, but in the past it used to be called Google, but even Facebook, right? I mean, if you look up Facebook's financial information from, let's say, 5 years ago, you would find that the profitability of Facebook 5 7 years ago was not there, not really there. I mean, compared to the stock market pricing. Even Amazon, go back 10 years and you'd say there's really no reason why. I mean, 10 years ago, who would have expected Amazon stock price or Amazon stock valuation to be where it is? Because you could not really see the investments that Amazon was making at that time into the web services. And right now, these guys are huge cash flow generating machines. But at that point in time, back in the day, their net income numbers were not there. They were possibly loss making. They didn't really have strong balance sheets in place. And of course, the question would be what really drives the stock price value? And people would have argued, oh yeah, there's goodwill, but can't really record it because accounting standards don't permit. So there has been sort of a conversation of sorts. There's two papers that your textbook discusses. The first one was written in 1999 by Baruch Lev and his colleague Zarovin. Um, and they found that um, stock returns and the net income reported by companies in the United States that had high research and development costs compared to companies with lower research and development costs, the association was very low for stock returns and the amount of reported earnings. Now, the rationale there is that in the US, right, and this is a US specific thing, research and development costs, R&D costs, have to be expensed. So if a company is, let's say, a high-tech company that engages in a lot of research and development activity, let's say it's a pharmaceutical company uh, that does a lot of cutting-edge research and development, all the costs, research and development costs in the US that the company incurs, they have to be expensed. Now, consider a company that doesn't have a lot of revenue just yet, but it's doing exciting work and it's literally on the verge of coming up with a product that's going to be a really, really, really massive, multi-billion-dollar sort of a game changer, right? But the accounting reality is that the company doesn't have revenues. The research and development costs that it's incurring are expensed. So on from an accounting point of view, the company is reporting losses. The market can see that the company has made a lot of advances on its research work, and it's on the cusp of making a breakthrough discovery, which will change its fortunes literally overnight. So the market would be very excited, and of course, you will see the stock price for that company to increase, even though the company is reporting losses, because the market is looking into the future. So that's what Levins Arvin found. And they said, rather than requiring companies to expense their research and development costs, we should allow companies to capitalize R&D costs. So consider it, you're dealing with a cost. At the end of the day, it's a cost, right? So the cost will result in the consumption of some assets. So either you're crediting cash is being paid, or you credit some other asset that's being used for the research purposes. What Levins Arvin are saying is that the debit, right? So the debit there in the journal entry, instead of it being an R&D expense, you should debit an R&D asset. So rather than flowing that cost through the income statement right away, considering it as a period expense, consider that as a product cost, right? So consider that R&D as the cost of whatever the product that the company is working on, um, coming out with, inventing or developing. And then later on, once the product is ready, then that cost could be amortized, just the way we amortize intangibles. So that was their recommendation. Kanodia, Singh, and Sparrow, 10 years later, they talked about the same topic and they said capitalizing R&D costs can actually help enhance value for investors and society. So there's a lot of investors that maybe don't understand the complexities or the intricacies of accounting, right? And so if they pick up the financial report of this company, right, that's engaged in R&D work, they will just look at the net income and they'll see, oh, this company's loss making. They might not understand why there is this excitement in the marketplace. Why is this company's stock price going up all the time? They might miss out on a good investment opportunity because they could not understand the relationship. The KSS, Kanodia, Singh, and Sparrow, they argue, just like Levin Zarwin, they argue, maybe it would be better if standard setters allow companies to capitalize research and development costs, because that can be seen as a signal. A company that invests in research and development, uh, you know, one would argue that's a signal to the market that this company is working potentially on the development of products that will generate a stream of positive cash flows in the future. Now there is a flip side, right? If you allow capitalization of all research and development costs, then there could be certain companies that will continue to do R&D without coming up with any product, right? So that's like, oh, I'm trying, and they do nothing. And as long as they keep capitalizing their R&D costs, if let's say the result is that they keep benefiting from an increase in stock price, that's a Ponzi scheme, right? That's nothing but a Ponzi scheme. They are literally befooling investors by claiming that we are doing this great research and development without going, being liable for libel. There is a company that I have a certain amount of investment in up in Red Deer that's been making claims about being able to make diesel from uh, from waste oil and that kind of thing. Waste. That's the name is CLO Waste Solutions, and yeah, they've been talking, and they literally don't have any product to show. So probably I'm going to lose money there. But like for that company, if it was able to capitalize its costs, it could mislead a lot of investors because they would be looking at, oh, we're getting this stock at such a discount and so on. Now, if you make a linkage between what Levin, Zarwin, or KSS are talking about, capitalizing R&D costs, and you consider the case of extractive industries like oil and gas, right? We talked about oil and gas accounting. Oil and gas companies, uh, at least ASPE, allows the use of full cost. So under full cost, oil and gas companies, when they drill wells, they are allowed to capitalize all the costs of exploratory drilling and all and put that on the balance sheet. So it's an interesting piece. When we consider the IFRS treatment or ASPE treatment in Canada for research and development, research expenses have to be expensed. Research costs have to be expensed. But development costs, as long as they meet 6 criteria that you learned in your intermediate class, as long as those 6 criteria are met, that there's technical feasibility, adequate resources must be available, there must be a market or use, there must be an intention to develop the asset for ultimate sale or use, internal use, etc. There's 6 of them that have to be met. Well, development costs can be capitalized. Both ASPE and IFRS allow capitalization of development costs. Research costs, you can't, you have to expend. Compare that to US GAAP, even development costs have to be expensed. So what Levin, Arrow and Kanodia Singh and Sparrow are arguing, at least partially is permitted in Canada, right? IFRS and ASPE allow development costs to be capitalized. Curiously, with oil and gas companies, ASPE allows the use of full costing. IFRS doesn't, but ASPE does allow. IFRS has something called successful efforts. So it's conceptually similar to the allowing of capitalization of development costs. So wherever a company was successful in finding oil and gas reserves, those costs can be capitalized. But wherever you dug up an empty well, right, you have to expense the cost. That's IFRS for you. The question there is why? Why is there a distinction made? From an ASPE point of view, why does ASPE allow full costing for oil and gas companies, but not for R&D, right? Only development costs are permitted to be capitalized. Research costs have to be expensed. Why do you think? So IFRS, there's really no distinction, but ASPE, oil and gas companies, they can, whatever is the cost of drilling that they are incurring, regardless of the outcome, whether they found oil and gas, they did not hit any reserves, they're allowed to capitalize their cost, full cost. But a company that engages in research and development, only development costs are allowed as long as they meet 6 very rigid criteria. Why do you think that that's the case? Okay, I'm going to give you a hint to see if you can work it out. Think about what the possible outcomes might be for an oil and gas company. An oil and gas company, ASPE allows them to capitalize all of their exploration costs, of it full costing. Either they'll find oil, and if so, they will then start earning revenues, and they will start amortizing the capitalized exploration cost. And so over time, they will start expensing those exploration costs against revenues. It's a matter of timing. Consider the R&D company. So let's say this company is working on a potential, because ultimately a company that does research and development, the result is in the form of a patent, right? You file for a patent, and then you either use the patent to come up with the product yourself, or you sell the patent to another company who will then market that product, make and market that product on their own name. So ultimately, it's about the benefit from doing the research and development. Now, patents by their very nature, you think about, let's say, I don't know, like cure for a certain type of cancer, for example. If one company comes up with a potential cure for a certain type of cancer and they file for a patent, then the market for that particular cure is done. No other company can duplicate and get a patent for the same procedure. Patent protection, it lasts for 20 years, like that's the maximum legal life, although the useful life might be less than the 20-year time frame, but patent protection tends to be for many, many, many years. So when it comes to R&D, it's a winner take all situation. If you have more than one company working on the same problem, that company which comes up with the solution first and is able to convince the patent office that their solution works will basically walk away with all the spoils. So a requirement, part of the 6 criteria for capitalizing development cost is technical feasibility must have been established. The company has the resources to complete. The company intends to complete. There is an actual market. So all of those questions have to be satisfied before accounting standard setters say, all right, you guys can now start capitalizing these. Until you hit that milestone, though, no matter how much of money and resources you've expended, there is no guarantee of success till that point, right? Research costs, expense, expense, expense. For an oil and gas company, successful efforts will have the same outcome. That's what IFRS does. Under IFRS, successful efforts, if you did drilling and you came up with nothing, expense that cost. If you did drilling and found reserves, well, then you can capitalize that cost. So IFRS treatment for oil and gas companies is similar to its treatment for R&D. ASPE, on the other hand, makes that distinction that development costs for a company that engages in R&D, only development costs can be capitalized. But from an oil and gas company's point of view, because the oil and gas company has to acquire exploration rights, so there's a certain stretch of land that the company has to get the rights to go out and explore, there is no other company that is able to come into that particular area, right? So it is not a winner take all. So if let's say, if I'm a private company, oil and gas company, and I get rights towards exploration in over, let's say, 1,000 square kilometers in northern Alberta, no one else can come and do exploratory drilling in the area that I'm operating in. Okay, so I'm the only party. So as under ASPE, fine, if I'm carrying out exploratory drilling here, it's everywhere, they can let me capitalize those costs. If in the end I found nothing, I'll have to write off an impairment loss, right? Because ASPE requires impairment testing. So if I've done a whole bunch of testing and I found nothing, I will take a huge bath later on, right? Ultimately, I will need to write it off either as an expense or as a loss, right? And if I'm lucky and I found reserves, then I'll start making some revenues, and over time I will be able to amortize the capitalized exploration cost. I'm not in jeopardy of being an also ran in a single, in a race that only one party can win, which is what research and development is about. So companies that work on high-tech research, for them, it is important that there should be an expectation of success. Oil and gas is a different beast. Okay? Does that explanation kind of make sense to you?